You've done your research. You know you need funding. You're ready to apply for a business loan. But before you hit submit on that application, there are 5 things you need to have ready. And I'm not talking about just having a business plan. I'm talking about the specific documents and information that lenders actually ask for. The stuff that can help separate a smoother application from one that gets stuck in back and forth for weeks. I work in small business lending, and I see this every single day. Borrowers who come in prepared usually have a much smoother process. Borrowers who don't end up delaying their own funding, sometimes by months. So let's make sure you're in the first group. Thing number 1. Your business financial statements. There are 2 key financial documents lenders will ask for: your profit and loss statement and your balance sheet. Your P&L is cumulative. It shows everything your business earned and spent over a specific period of time and tells lenders whether your business is actually making money. Your balance sheet, on the other hand, shows what your business owns and what it owes at a specific point in time: your assets, your liabilities, and your equity. Together, these 2 documents give lenders a picture of your financial health. We're going to do a dedicated video on the most common mistakes people make on each of these documents, because small errors can seriously slow down your loan application or create issues during underwriting. So stay tuned for that. Thing number 2, your business and personal tax returns. Most lenders want to see 2 years of business tax returns, and sometimes your personal tax returns too. Why personal? Because for a lot of small businesses, the owner's personal financial health is part of the picture. Typically, lenders want to see that the numbers on your tax returns match the numbers on your financial statements. If they don't match up, that's a red flag that will slow everything down. Thing number 3, your business bank statements. Typically, lenders want the last 3 to 6 months of your business bank statements. This is one of the most important documents and one of the most overlooked. Your bank statements show your actual cash flow, not just what your tax returns say, but what's really moving through your account day to day. Lenders look at your average monthly deposits, your spending patterns, and whether your balance is consistently positive or constantly hitting zero. If your statements show a lot of overdrafts, inconsistent deposits, or unusual activity, that's going to raise questions and could slow down the loan process. We'll be doing a separate video where we dive deeper into exactly what lenders look for on bank statements, what can cause delays, and what you can prepare for ahead of time so you're not caught off guard when the underwriter starts asking questions. Thing number 4. Proof of business ownership and legal documents. This includes your business license, your articles of incorporation or organization, any operating agreements if you have a partner, and your EIN. That's your employer identification number. Basically, lenders need to verify that your business is a real, legally registered entity. If you've never formally registered your business, this could be a significant barrier with most lenders and is worth addressing before you apply. Thing number 5. A clear explanation of what the loan is for. This one surprises people, but it matters more than you think. Lenders want to know exactly what you're going to do with the money. Are you buying equipment, hiring staff, covering a cash flow gap, expanding to a new location? The more specific you are, the better. A borrower who says, "I need $50,000 for working capital," is way less compelling than one who says, "I need $50,000 to purchase 2 delivery vehicles that will allow me to take on 3 new contracts I already have lined up." Tell the story. Make the lender see why this loan makes sense for your business. So there you have it, the 5 things you need before you apply for a business loan: financial statements, tax returns, bank statements, legal documents, and a clear use of funds. Here's my advice. Pull all of these together right now before you even start looking at lenders. Put them in a folder on your computer or in Google Drive. When you're ready to apply, you'll be able to move fast instead of scrambling to find documents at the last minute. In my experience, the borrowers who move the fastest aren't always the ones with the biggest businesses. They're often the ones who come prepared. Now here's something important. Gathering these documents is step 1. But once a lender has them in hand, there's a specific calculation they run that determines whether your business can actually afford the loan you're asking for. It's called your debt service coverage ratio, DSCR, and it's one of the most important numbers in the entire lending process. Most borrowers have never heard of it. In the next video, I'm going to break down exactly what DSCR is, how lenders calculate it, and what lenders generally like to see when they're evaluating your application. Subscribe so you don't miss it, and drop any questions in the comments. I read all of them, and I'll see you in the next video. And before you go, quick reminder that everything on this channel is for educational purposes only. I'm sharing what I've learned from working in small business lending, but this is not financial or legal advice. Every situation is different, so always work with a qualified professional for your specific needs.